In what he calls, quote, a Houdini act of epic proportions. Rosenberg says the U.S. Federal Reserve has managed to create a disconnect between the economy and stock markets, pointing out that U.S. equities are reaching five-year highs, even in the face of weak and weakening economic data. Joining us now, David Rosenberg. Great to have you back with us.
Thanks, Howard.
QE3. And all the other QE that's going on everywhere else. Here's the quote. I personally don't think this QE is going to do squat for the economy.
It's one of the laws of motion from Newton, that every action has an equal and opposite reaction. And as we saw with the other QEs, one of the reactions as the Fed tried to generate risk-taking behavior and wealth effect was they drove up commodity prices. Well, it just so happens that part of that commodity price complex is food and energy. And although investors may drive those prices up along with other risk assets, for regular households, that's what we consume in our family budget. So when you're talking about 25 to 30% of what you spend is food and energy, and those prices end up going up, it crimps spending in other parts of the economy. So if you're wondering, gee, why it is, we've already had 2 rounds of quantitative easing, right? We had Operation Twist. It's not as if the Fed's been sitting idle over the past 3 years. It still hasn't managed to generate sustained economic momentum. It's because there's been some offsetting impacts as well.
So now what? I mean, we've got QE everywhere. Now what?
You sometimes have to sit back and assess what the markets are telling you. We have, for example, not only reported earnings are down 2 quarters in a row, now operating earnings are declining. We have a global economy that's in a dramatic weakening trend. And ordinarily, you'd be saying, boy, that should be generating a very squishy, soft market. And up until very recently, the stock market was actually going to a new high. So what's been happening is that the Fed has managed to almost cause this, more than just a trial separation, but almost a divorce between earnings and the economy here and the stock market over here. Because what you're ultimately paying for as an equity investor is you're paying for some future earnings stream. What the Fed has done very cleverly through its interventions and through the threat of more intervention is be able to drive real interest rates further and further into negative territory. Howard, we are in the realm of the unknown. Real interest rates have never been this negative in the post-World War II experience.
And they're negative because of the rate minus inflation.
Well, that's right. And look what the Fed did. This is something different. This is a new leg in the Fed's easing policy. In the past, quantitative easings, they might have been fighting some double-dip recession. Primarily, they were fighting deflation. When they announced last week this open-ended quantitative easing, they did it at a time when gold was testing its highs, the dollar was testing its lows, and where market-based inflation expectations from the TIPS market were actually at the high end of their range. These are all things in the past that would have caused the Fed to have conniptions. This is the environment that the Fed chose to announce open-ended quantitative easing. So they're trying to generate heightened inflationary expectations. That's one of the ways you drive real interest rates negative. What's important for the equity market, of course, is that these negative real interest rates, that is inherently your discount factor for trying to estimate the present value of that future earning stream. You have to have a discount factor. That discount factor, for all intents and purposes, is negative. And that's how you can explain this lousy economic environment that we have, and yet financial assets, primarily equities, have managed to make new highs. Is because
so the model's skewed.
Well, it's about the Fed's manipulation of the marketplace having an impact on the discount rate and having an impact on the market multiple. And that's why you have this disconnect between Main Street and Wall Street right now.
Okay, so the indications are that a lot of people say that housing's getting better. Little doubt of recovery in housing. So, I mean, is there a recovery going to come from housing if this is actually occurring?
Okay, well, you know, housing is recovering. You can't argue against the data, whether you're taking a look at prices or you're taking a look at housing starts or home sales. We're coming off of record low levels. And so nothing's going to go to zero. You do have some underlying demographic demand. At the same time, as Barry Ritholtz said earlier on your show, that housing affordability has picked up. We're seeing a recovery in housing, but if you take a look at my report and the chart of home sales and the chart of housing starts, I mean, you take a look at a 40, 50-year chart, you've got to squint your eyes to really see the recovery. But if you take a look over the past 12, 24 months, yes, we're off the bottom. What does it mean for the overall economy? You know, housing now, 2% of GDP. Manufacturing is 10% of GDP. What drove the recovery in the past 3 years? Whatever recovery we had wasn't housing. We actually recovered without housing. And we recovered because of the manufacturing sector. Manufacturing sector has a direct contribution to GDP 5 times as big as the housing sector. So you're going to tell me that housing is going to make the difference between the economy tipping over or not. And actually, I would submit to you that it's going to come down more to the manufacturing sector that's going to be on residential real estate.
So you see, as I understand it, another 5 years of subpar growth, 2% or less, which, if true, means virtually no change in the employment levels, right?
Well, it doesn't mean much change in the overall levels of resource slack in the labor market. So it's not just employment will probably rise just because of demographics. I mean, you do have natural population growth. It's a matter as to whether or not this unacceptably high level of unemployment is going to come down over time. And frankly, I'm skeptical that it's going to. We have to ascertain, and I think that we have, that this was not a normal, plain vanilla manufacturing recession that we grew accustomed to understand in the context of the post-World War II experience. We are running a movie backwards. The movie was called a 30-year secular credit expansion that went parabolic from 2002 to 2007, and we're still paying the price for that in some respect. And now, of course, the government sector has to go on the debt treadmill. McKinsey did a report, Howard, a few years ago showing that in the context of a credit cycle, a negative credit cycle, which is what we're in right now, and government central banks are fighting this hard, as if Japan hasn't fought this hard for a long period of time. The McKinsey folks did a whole cross-section study on this and found that it's not unusual to have a 7-year transition phase to the next sustainable economic growth period. So I'd say right now, we're probably maybe somewhere in the 5th or 6th inning, but the ballgame ain't over.